Welcome to my podcast. I'm Reagan Bashara, founder of Ollie's Accounting, a bookkeeping and payroll services firm based in the United States. I have almost a decade of small business accounting expertise to share with my clients and the business community at large. I want to help you define your beliefs and values, create better procedures in line with those values, and realize your financial agency and independence as a small business owner. Whether you've got a side hustle or a fully fledged business with a team of employees, we all share the same struggles against our limiting beliefs. Let's overcome those together by imagining new ways of doing business. Today we're going to talk about credit and debt, specifically in the United States. I'm not going to provide credit advice because that's not really my area of expertise. Instead, once again, we are discussing the way that financial agency and independence intersects with credit score reporting. You may be aware of the fact that you have a credit score, whether or not you want to use your credit to pay for anything. If you have a social security number or individual tax ID number, you more than likely already have a credit history. The fact is that unless you can and want to pay cash for certain things in your life, you're going to have to utilize some form of credit to fund these life choices. This includes choices such as buying a car, buying a house, making upgrades to your home, paying security deposits or not for utility providers, paying for your cell phone, paying tuition and fees for higher education, and anything, quote, extraneous that requires you to pay money like unexpected medical events. But credit scoring can also be used to determine your eligibility for employment, housing, and insurance. Unfortunately, as with most systems in the United States, credit scoring has led to discrimination, bias, and classification of individuals in a way that shapes their lives. Credit scoring has drawn much criticism from media outlets, unions, other organizations, and even government officials. Assignment of a credit score is not necessarily voluntary. If you have a social security number or a tax ID number and you file taxes, you have a credit history whether you apply for financing for anything. Most financial related activities ask for or require inputting this identification number. But since successfully obtaining financing from any lending institution or creditor is heavily weighted on your credit score, and people are sorted into classifications of having poor, fair, good, very good, or exceptional credit, starting with little to no credit may mean that you get denied access to financing for assets, such as a car or a house, and denial for even employment, housing, and insurance, including rental. For instance, in many states, car insurance is mandatory to even purchase a car, obtain a driver's license, register a car, and transport to and from work. The rate at which you pay car insurance can be affected by your credit score. One of my sources today is the National Consumer Law Center, which has published articles about credit and the racial disparities in the U.S. financial credit reporting system. So according to the NCLC, credit reports and scores can reflect racial disparities and can perpetuate discrimination. African American and Latino communities have been shown to have lower credit scores as groups than whites. And since lower credit is considered, quote, bad, and credit can be used to determine employment and housing eligibility, credit essentially segregates communities by removing access. The NCLC says that rather than these racial disparities being based on actual differences in culture or determined financial responsibility, which means can you pay your bills and can you pay them on time, credit is simply the judgment of humans based on past behavior. And by necessity, this incorporates elements of past inequalities into the credit reporting system. As I've discussed on prior podcast episodes, there is a racial wealth gap in the United States due to our country being built on centuries of discrimination, oppression, and exploitation of a coerced workforce. The Federal Housing Administration practiced redlining communities by not guaranteeing home loans in African American communities, denying access to home ownership to Black communities, and preventing them from accumulating wealth and land equity. Credit scoring is used as a gatekeeper for life's necessities. We've already talked about that: employment, housing, insurance, and affordable credit. This reinforces the already existing inequalities in our society. Credit literally dictates your access to future opportunities. But I want to talk about the idea that credit can be affordable. So let's imagine this example of buying a car. Let's say that you have a 650 credit score, which is considered a quote fair on the FICO scoring range, just one level above quote very poor. When you apply for financing for a new $20,000 car, you don't have a down payment to make, so you need to finance that total $20,000, which means you're taking out a loan for that amount, and you have to pay that loan back over a period of time. And according to NerdWallet, which is a website that has an auto loan calculator, so you put in how much you need to finance the loan for, what your credit score is, what your interest rate will be, and they tell you through their calculations what your monthly payment might be, and how much you pay overall for the total loan for the car. So according to NerdWallet, the average financing rate for a 650 credit score would be about 6.57%. This financing would result in a monthly payment of $336. And over the total loan, so if you pay the loan off over a period of 5 years, that's the term of the loan, you pay a total amount for that car of $24,254. So not only did you pay the $20,000 for the price of the car, but you've paid about $4,200 in interest because you had to finance. Now let's imagine that you bump up your credit score to 720. That's 70 points higher. This results in an average financing rate of about 4.03%. Your interest rate, when you have a higher credit score, is now way lower. This is over 2 percentage points lower than that 6.57% rate. Without making an additional down payment, your monthly car note would be $313, and you would only pay $22,548 over the same term of 5 years for the loan. So you're not saving that much more money on your monthly payment for the car, but you've actually reduced the total amount that you paid for the car, the interest, by about half. This is what we mean when we talk about affordable credit. Because a lower score indicates that you may be someone who cannot be relied upon to make payments on time. You can't pay a loan in full. You don't have more job or housing security. You end up paying more for the same car than someone with a higher credit score. The assumption is literally baked into your credit score that you can't be relied upon to pay back the loan in full or make payments on time. So you're expected to pay more than someone who has higher credit, possibly more job or housing security. Maybe they have a higher level of education. Maybe they have access to equity or other financial support that would help them be a more reliable payer. And to take this example one step further, let's assume that the person who has a higher credit score of 720 already owns a vehicle that they want to trade in, and they get a $3,000 credit on that new vehicle purchase because they traded a car in. Or instead of a trade-in, they're bringing $3,000 cash down payment to the table. Either way, the amount that they need financing for that new car is lower, so they only need to finance $17,000 for that car. This actually reduces their monthly payment to $266, and their total payments on the car over the term of the loan to $22,166 over the same period of 5 years. By having a higher credit score and a down payment or a trade-in, they need less financing, and they've reduced their monthly payment by about $70. That's $70 more cash in their pocket than the person with the lower credit score, and it reduced the total cost of the car overall. They also probably qualify for lower car insurance rate if that's determined by their credit score as well. People with better credit pay less for the same things. And since we know that credit is perpetuating prior inequalities, folks who are already facing barriers to better financial opportunities are paying more for access to those opportunities. And this is just assuming that credit is the only thing holding marginalized people back. We know that there are other systems of oppression and inequality that are getting in the way of better opportunities in life. Now, on a macro level, there are ways that we can push for the dismantling of these oppressive systems. The NCLC suggests that there are ways to adjust for discrimination in credit scoring, and they suggest having a more accurate model of predictiveness, so using different data to say whether or not somebody can make payments on a loan, whether they deserve to receive better financing that's going to cost less over time. On a personal level, I believe that changing our outcomes starts with better representation and dismantling how these systems are alive in our own ways of thinking. I think that learning how to advocate for better pay, better working conditions, better housing, better health care, and better social status is how we create more robust communities. Starting a business and providing value and support to your community through whatever products or services you provide is a great way to do this, but also hiring in an equitable way and paying more than just a fair, livable wage. Hiring somebody, paying them for the actual value that they provide to your business, not just the things that they take off your plate, but how they allow your business to grow and scale. I talked previously about non-hierarchical business structures like cooperatives, or simply antidoting the paternalism and power hoarding in your current organization by being more collaborative and communicative with your employees. People are valuable and inherently worthy regardless of any external classification. That includes credit scoring, and it also includes the algorithmic assignation of projected value from your current customers or clients. If you see a dollar sign over someone's head, you're judging their value or worthiness based on what they can pay you, rather than focusing on the kind of relationship that you can build with that person and how you can support each other through exchanging goods, services, and money. The dismantling of the oppressive system of credit scoring in the United States has to happen on the national level for sure. But additionally, we must create connected communities and build equitable businesses that hire and are led by people from all different backgrounds. That's all I have for you today. If you have questions or comments about this or any episode, come leave me a comment on my Instagram at AllEaseAccounting. I'll talk to you later. If you are enjoying what you're learning on this podcast, please consider supporting me through a subscription on Anchor.fm. Any donation amount is welcome, or you can simply share it with someone you know. You can also follow me on Instagram at AllEaseAccounting and sign up for my email list at alleaseaccounting.com/subscribe. Thanks for listening.